Okay, let's talk about investing in bonds. So now we're going to go buy IOUs of other companies. So they're going to pay us interest semi-annually, and maybe we'll sell those bonds, or maybe we'll hang on to those bonds until they mature. And how we account for the interest revenue is pretty straightforward and pretty much the same no matter what bond we're looking at. But how we account for unrealized gains or losses will change. In other words, what happens if while we're holding a bond, interest rates go down so the bond price goes up? What do we do with that unrealized gain or loss? And that's going to depend on whether we call it a trading bond, an available for sale bond, or a held to maturity bond. Well, what do I mean by those different categories? A trading bond is a bond that we're going to buy or sell pretty quickly. It's usually a current asset. It means that sometime within the next year, maybe even within the next 30 days, we're going to sell that bond. We think we can make money on it. The way I think about these are, we're telling the world we're smart. We can buy and sell these bonds and make money. Available for sale means we've got some extra cash laying around. We're tired of earning 0.5% on our savings account at the bank. So instead we invest in some 5%, 6%, 7% bonds. We'll sell them when we need the money. We're not actively trading them. And held to maturity, suppose we know that we're going to need $100,000 for a capital project 5 years from now. We might buy a 5-year bond and just hold on to it till it matures. And like I say, how we account for interest income in the meantime is pretty much the same for all these bonds. The trick is, what do we do with unrealized gains or losses? Unrealized gains or losses means that we ain't sold the bonds yet, but they've gone up or down in value. And so what we're going to do with held to maturity bonds is we're going to ignore that. We told the world we're going to hang on to this bond until it matures, so whether it goes up or down in the meantime, we don't care. When it comes to trading securities, we told the world we're smart, we can buy and sell these bonds and make money, so we got to put our money where our mouth is. We'll write those bonds up or down on our balance sheet. We'll probably keep track of that in a separate account called fair value adjustment, so we can keep that number separate from what we originally paid for the bonds. And the offsetting debit or credit will be right in here, other revenue and gains or other expenses and losses. So even if we haven't sold a bond and it's gone down in value, we will decrease our net income. And the way I remember that is, we told the world it was a trading security. We told the world we're smart. We can buy and sell these things and make money. We have to put our money where our mouth is. Even if we haven't sold that bond yet, if it's a trading security and it's gone down in value, that loss has to be included in our net income. Now, if it's available for sale security, in other words, we bought the bond, we're going to sell it when we need the money or when we think the time is right, we're going to adjust it. We're going to put it on our books for its fair value. We're going to keep track of that fair value adjustment in a separate account over here on the balance sheet. But we're not going to book that gain or loss in net income. Instead, there's a brand new account here underneath net income called other comprehensive income. I say this is stuff that ain't happened yet, but it's important enough we ought to tell people about it. And whereas net income is going to close into retained earnings, other comprehensive income, stuff that ain't happened yet, but it's important enough we ought to tell people about, is going to close into accumulated other comprehensive income. All right, let's walk through an example. We buy $50,000 worth of Doane Inc.'s 8% bonds. We pay par value for them, and there's no brokerage fee. So we debit an account called debt investments for $50,000 and credit cash for $50,000. Remember, in the real world, bonds pay interest twice a year. So let's say this bond pays interest on July 1st and January 1st of every year. Our book sometimes slips back into annual payments. Let's be true to the real world. $50,000 times 8% would be $4,000 a year, so that would be $2,000 every 6 months. Let's pretend like we didn't accrue for any interest revenue in the meantime. So we debit cash for $2,000. Cash is an asset, it increases with debits, and we credit interest revenue for $2,000. If expenses are debits, the opposite of expenses is revenue, so they must increase with credits. These bonds pay interest on July 1st and January 1st. So we get to December 31st, we got to get that interest revenue into the year. So we're going to debit interest receivable, that's an asset, it increases with debits, and we're going to credit interest revenue. So we're accruing for the semi-annual interest payment that's going to be made on January 1st. So then January 1st comes, they cut us a check for $2,000. We debit cash for $2,000 and we take that receivable off our books for $2,000. So now we've got that interest revenue for the last 6 months into last year, even though we didn't physically collect it until the next year. That's accrual accounting. Okay, now let's pretend like it's January 1st. All of a sudden the bonds go up. They were worth $50,000 before, now they're worth $54,000. We sell them, we debit cash for $54,000. We take them off our books with a credit of $50,000. Remember, they were on there with a debit balance of $50,000. And the difference is the $4,000 gain. And obviously that's going to be part of other revenue and gains on our income statement. But now let's pretend like we don't sell them. Let's pretend like the bonds go up in value by $4,000 on January 1st. We've got an unrealized gain. We aren't going to sell them. All right, let's pretend like we don't sell them, but it's January 1st and overnight the bonds went up in value by $4,000. So we'll adjust them on our balance sheet to put them on our books at fair value with a $4,000 debit. So that's going to increase the value on our books. And we'll book a gain of $4,000. If it's a trading security, and if we originally booked these investments as a trading security, we said to the world, we're smart, we're going to buy and sell these things, we're going to make money. We have to put our money where our mouth is. That unrealized gain gets to go on our income statement. Now, if they were available for sale securities, the treatment is a little bit different. Okay, so if we had originally booked these as available for sale securities, we didn't run around telling the world we're smart, we can buy and sell these things and make money. They're not trading securities. We're saying we have some extra cash laying around. We're tired of earning 0.5% in our savings account. So we're going to invest in these bonds and make a little bit more money. What's going to happen is we're still going to have to mark them to market. We're still going to have to put them on our books for fair market value. So in this case, they've gone up by $4,000. So we'll have an account called Fair Value Adjustment for Available for Sale Securities, and these things will now be on our books for $54,000. That unrealized gain or loss, however, is now part of other comprehensive income. It's down there at the bottom of the income statement. I think of it as stuff that hasn't happened yet, but it's important enough that it should show up on our financial statements. And then that account closes into accumulated other comprehensive income on our balance sheet.